Hello and welcome to the Rask Network. What you're about to hear and see is limited to general financial information only. Please be sure to speak to your financial planner or refer to our financial services guide available at rask.com.au/FSG before acting on the information.
G'day, welcome to the 2 Cents episode of the Australian Property Podcast. I'm Pete Wargent and I'm here with Chris Bates. Batesy, how are you?
Life's good, Pete. Week 2 back at work and can't remember the holiday now. So it's been a pretty full-on start to the year. How's things going for you?
It's a winning day for Spurs and Liverpool today, so we should be very happy on the podcast. Plus the inflation figures were actually pretty good this week. So I guess all in all, life's pretty good. I've got a week in Dubai ahead and then back to Australia. So can't complain too much, I guess.
Yeah, absolutely. We kind of delayed this morning's podcast so I could finish the Liverpool game. So thanks for that, Pete. But absolutely. I think the inflation figures I just think it's that the sentiment has shifted. We said about this a few months ago that, over months can be a long time for sentiment to shift. And, the more and more positive news that comes around inflation, the conversation's getting more and more intensifying, I guess, around rate cuts and when they're coming. And, they're starting to look earlier than expected. And, once they start coming, the sentiment will start to shift again.
Indeed. So we've got 3 top stories of the week to cover off today. Firstly, we'll take a look at those inflation figures, which have been all over the media this week. Secondly, a lot of talk about tax reform, which can be a bit of a dry subject, but it won't be with us, Chris, will it? So we'll talk a bit about the political cycle, what comes next for Labour. I guess they've had some controversy with the stage 3 tax cuts, and now people are talking, okay, but what comes next? I guess there's the progressive side of politics. They're going to take a look at various tax reforms. So we'll have a look at that and what it means for the housing market. And then thirdly, a couple of pieces in the Fin review this week with Nyla Sweeney, taking a look at Ray White research in terms of which parts of the housing market have really outperformed. Quite often it seems the premium end of the market has done very well over the past decade. There's also some figures on suburbs where unit prices have tripled over 20 years. But I think in some cases, we'll take a drill down into the data because I think sometimes those figures can get skewed by new build apartments pushing up the medians and so on. So we'll sort of have a look at that and put our own sort of take on it. So let's start with those inflation figures, Chris, because I guess that was the main sort of big news story this week, not just for the housing market, but just for the economy in general and consumers. So inflation was 0.6% in the December quarter. So that's way better than market forecasts. So there was still some inflation in tobacco excise, insurance costs, which we all know have been painful. New dwelling costs still rising. Rents were up, but not quite so much, I guess, because of the Commonwealth rent assistance, and electricity costs were still up, which I think will calm down a bit as the year goes on. So look, over the year, 4.1%, which is a lot better than expected. It was better than the Reserve Bank was forecasting. So that's really good. And there's probably more global disinflation to come with lower energy costs and so on. And they also look at these, the core measures of inflation as well. So 0.8% for trimmed mean inflation. And actually, if you look at to a couple of decimal points, it was pretty much back to the target. So I guess this is, you never quite know, do you, Chris, with these releases? There's a lot of parts to the machine and you never know what's going to get spat out, but it was lower than expected, I guess, which is fantastic news for the central bank and probably a big sigh of relief for a lot of consumers as well.
Yeah, and I guess I'm going to put you on the spot, Pete, but I mean, globally, we're a bit behind everyone, right? I mean, if you go globally, the story is even much more positive than here. The inflation genie back in the bottle. I think that, that's the one that you don't want to get out because it can become this inflation spiral. But are we going to navigate this inflation back in the bottle and get this soft landing? I mean, it seems like that could be the situation we're heading towards. What's your take on the world and where we're sitting?
It does seem to be. I think you're right. Australia and to some degree Japan are running on a slightly different cycle, largely because we had the borders basically shut for months and months while the rest of the world was reopened, like in Europe and parts of the US. They got back to normal much sooner. So you're right. We're further behind on the journey. I think, we're basically following the rest of the world down for inflation in the same way that we followed it up. I think if you drill into the inflation numbers. If you look at the split between tradables inflation and non-tradables, in other words, inflation that's driven by global trends versus what's happening domestically, well, the global disinflation pulse is massive. Inflation there is already down to 1.5%, and it's absolutely plummeting. There's more to come there as well. I think, yes, domestically, we have got some inflation sticking around, and it's in things like services, insurance, and those kind of parts of the economy. But that's exactly what you said, right? People see the opportunity to bump up prices, and they do, and that's why it can stick around. But the global disinflationary trend has really helped us. I think if you're looking at the other side of the equation, what could throw a spanner in the works is basically conflict. If conflicts flare up and around, say, the Red Sea, and oil price suddenly spikes from 80 to 200 or something like that, that's when the shit could really hit the fan. Not just from a global perspective, but also from an inflation perspective. But yeah, if you look at what markets are pricing, Australia's 3-year bond yield, 3.5%. It was 4.5%. It's really come down over the past 6 months. If you look at the cash rate, well, it's now 4.35%, which is higher than the rate of inflation now for the first time in quite a long time. But if you look at what markets are pricing, an interest rate cut in May is basically 50-50. 2 cuts priced in by the end of the year. And if you look out to June 2025, 3.5%. So I think, yes, whether it happens sooner or later, not really clear. But for sentiment, the fact that people are even talking about rates coming down instead of going up is a huge shift in, even from 3 months ago, where people were still talking about the need for hikes.
Yeah, and I think the issue we sort of could see that if rates went higher than people expected, which I say they did, people weren't expecting rates to go from 0 to 4.35%. But how long do they stick around there? And how long does it till all the savings starts to really run out, all the buffers, all asking family for help, using any refinancing loans, etc. And saving rates have been dwindling, right? But we haven't seen arrears rates tick up, and I think now people are going to be saying, well, if rate cuts are coming, what I just need to do is navigate myself to the other side. The positive around rate cuts is not just sentiment. People want to get ahead of it. I want to buy because I know that as rates go down, the attraction towards entering the property market increases. The desirability, the appetite for debt will increase because it's cheaper. I want to get ahead of that. Plus, I'm in a rental crisis. Plus, I know I should have upgraded 3 or 4 years ago. So I'm in I'm already running out of space in my apartment or my smaller house. And investors will start entering more and more because investors will go, well, my cash flow is going to get better. I know it's a bit more expensive now, but if I can hold on for a few years and rates come back down, then that negative cash flow is going to reduce and potentially rents are going to go up as well. So, I think a lot of people who are potentially running out of savings right now are going to say, right, if I can just get through this window, next 6 to 12 months, and refinancing is becoming easier. Because incomes are going up, but banks are quite happy to lend. There's been a lot of innovation around lower assessment rates, etc. As rate cuts come, that means borrowing capacities go back up. So there's going to come this time where the people who are struggling, who haven't been able to refinance, maybe they took on a lot of debt in 2021. They didn't get those wage increases that they were hoping, but all of a sudden they're starting to come through now. And the borrowing capacity is back, and they can finally refinance. Because what would be holding them back is if the property values didn't go up. But as we can see, we're almost back at 2021 highs again, if not higher in some suburbs. And so, potentially the asset value has actually gone up, and they've paid their mortgage down, and potentially they could refinance, no issues under 80%. So, maybe there's a sort of that slim line to a soft landing. I think it's almost happening right now. Like you say, though, we never know with a black swan event like a crisis in the Red Sea.
You're right. I was interested to see in the Reserve Bank's financial aggregates that investor credit growth, so growth in lending essentially to housing market investors, it's been very, very low now. It's been under 3% year on year for the past 6 months. And it was slowing through October, slowing through November, and further in December. Now, that's a net figure. So some people are selling some are buying. So that would account for the rental crisis. But I think the thing that is really interesting, Chris, you identified a week or two ago, we're now into February, and I'm seeing a lot of parents saying, look, I was planning to pass on this money to my kids in Sydney or Melbourne or wherever it may be, and that was going to be their inheritance. But the rental market is an absolute disaster, and I'm just going to help them buy. And I've spoken to, so we're absolutely been flat out in Brisbane as buyers agents. But I've spoken to buyers agents in Melbourne, including Amy, who's on the podcast with us, and she suddenly got flat out busy. I've spoken to other buyers agents in Melbourne and Sydney, flat out. Perth is flat out. So I think, there's a couple of things. Obviously, there's a dearth of stock. There's definitely an intergenerational wealth transfer now happening. That was one of those things. I'd sort of read the themes and all this, but now I'm seeing it firsthand. Parents are saying, well, there's no point in having my kids on the rental market with rents going up. There's no good properties around to rent, and I'd rather see them buy. And the with prices rising, that's definitely happening. So I guess, the rental crisis. I mean, the inflation figures for rent seem to cool off this quarter, but that was actually because of the rent assistance, not because the rental market crisis has been fixed. Lots going on there. And I think, as you said, probably we'll start to see some investors coming back in 2024 as well.
Yeah, there's always a pent-up demand in the property market. If everyone was living in the homes that they would want to live in, if our owner-occupier rate was, well over 70, 80%, right? And there was always choice, and you could just upgrade when the time was right, and stamp duty didn't exist, then there'd be this really efficient market. But that's just not the way that the property market works. You've got a lot of spare bedrooms with the downsizers and the baby boomers. You've got not enough bedrooms for the younger families. You've got etc. So there's this imbalance, and there's always this pent-up demand of people who would love to buy are in the rental market. And I think there's a lot of buyers that naturally and rightly so are a little bit cautious on entering, and it's a big thing. They're going to lose all their savings. They're going to have to go into a lot of debt versus renting. But ultimately, they do want to do it, and sometimes they get burnt in 2017. They get burnt in 2019. They get burnt in 2021. Where they're trying to enter and then it just becomes all too hard, and they just don't enter, but they still have that desire to buy. And we've, even in the last couple of weeks, a lot of pre-approvals over the last 2 years have come back at the start of this year and go, no, this is our year. We're absolutely going to make it happen this year. And I think that's what they're some of the buyers that really do drive prices, because they've gone through that experience before where they've missed out by, if they didn't spend that extra 10,000, they would have got in, and then they never got in, right? And they've seen how that just not paying that 10,000 has cost them a lot of money. And I reckon they're coming back into the marketplace right now, and they're looking at things quite subjectively. I guess they're saying, look, if I buy now, I can buy at this point, I can buy this place. But if I wait 6 to 12 months for that pay rise or rate cuts, I could spend maybe an extra 10, 15%, but am I going to have to pay 10 to 15% more? I can't afford to take that gamble. And so I reckon that's what we've noticed just coming in the last week or two, where those pre-approvals or people who wanted to buy over the last couple of boom cycles are coming back with a bit of a vengeance. And they're strong buyers. They've played the game before. Maybe they haven't actually, got the result, but they know what they're doing now. And when the right property comes up, they're very keen to take action. And that's what drives prices. When properties move faster than expected, there's that FOMO feeling starts to happen. And, just chatting to some agents, chatting to some buyers agents like you, Pete, after being away, we are seeing that there's an urgency there. This isn't to say that we're going to see huge boom numbers, but I do think there's enough buyers, and ultimately listings are going to stay low. There's always this false belief that all of a sudden everyone's going to rush to sell, and listings come after real price growth, and I think that's going to come when borrowing capacities go up, to be honest, and there's real confidence around rates. That's when people are going to be able to transact, and so I reckon it's going to be a pretty disappointing autumn again, with quality listings still very dire, and it's going to be tough buying.
You're right. If that's you, as a first home buyer or somebody who's suffering a bit of FOMO, you really need to do your market research, make sure you don't overpay, but spend a bit of time on your brief. Work out what are the must-haves, what are the nice-to-haves, what are the must-avoids. Get really clear on what you're looking to buy. And when the right thing comes along, then you can be decisive. Because, yeah, you're right. I think it'll be a competitive buying environment over the next 6-12 months. I guess just as you said, there's a lot of people been on the sidelines, weren't quite clear what was coming, but now it looks like interest rates have clearly peaked, and therefore that's going to bring more people back into the market. And yeah, there's just not that many forced sellers because people are now thinking, right, I'm going to hang on here. I'm going to see it through. We know mortgage arrears have stayed low, and if people can see light at the end of the tunnel, they're more likely to hold on, I guess, until interest rates start coming back down. Now, you mentioned their borrowing capacities, Chris. That's our second story, or at least obliquely related, tax reforms and the political cycle. So Labour Party has lost a little bit of popularity after backflipping on the stage 3 income tax cuts that were previously promised. And I guess it'll be popular with some voters at the lower end of the income earning scale, because actually some earners will get a better tax cut than expected, but it's really the people at 150k upwards who are expecting a nice 9k cut in their income tax, or at least at the top rate. People are expecting about 9,000. They're probably going to get 4.5 or thereabouts. So there's some people are a little bit pissed off, I guess, at that sort of backflip. So there's some talk about what comes next, I suppose, for the Labour Party. Now, we do know in Australia, we do tax income very highly. I mentioned I've got a week in Dubai coming up, where there's no income tax, very different setup there. But in Australia, we've seen the tax to income ratio is more or less gone from about 12% at the time of the financial crisis. Or to be fair, it was more like 15% pre-GFC. It's got all the way up to 19%. And the tax cuts will take us back down a bit to 18%. But really, with bracket creep, we do actually deserve some tax cuts, I would argue anyway. But where is Labour looking next? Fin Review says ALP may be looking at a 60 billion reform to tax family trusts, because I guess in the current environment, as you said, a lot of those higher income earners will now be thinking, right, how can I reduce my taxable income? And family trust is one of the ways. And that's probably politically quite popular. I guess the polls are now nearer 50-50 for the leading parties. So some talk about negative gearing and franking credits, but Labour have said after the last time or the last term's debacle, they're not going to take a look at that anytime soon.
Yeah, and I think I feel I'm getting old, Pete. I think you count all the elections and all the years that you sort of track things, and you start to feel like there's this big history of knowledge that you're building, and and how fast times moves, right? So I think the election's got to be before September next year or something. And so we're in February now. All of a sudden, it's the middle of this year, and then bang, we're talking about the run up to the election, right? And
are they too short, do you reckon? Are these cycles, 3-year political cycles? It feels like you've only just got the last one out of the way, and people are starting to eye off the next election. Wouldn't 4 years be the right kind of term? Look, I'm not a politics person, but it feels to me like we have way too many elections and too often.
Absolutely. I mean, coming from a financial planning background, I'm always thinking 10, 20, 30, 40 years, and 3 years just feels like, tomorrow to me. But in saying that, I was chatting to a client yesterday, and, they were basically making plans for the next 12 months. I think we could, we're just thinking this is what we're going to do for the next 12 months. They just, both of them were very short term in their thinking. And not to say there's nothing wrong with that. That's like living in the present and, taking life as it comes. There's a lot to be said about that. But, I do think that, when you look at some of the, I really love how the companies that have those 60-year visions or the 100-year, I think it's Japanese sort of, or the Chinese philosophy where it's these mega trends and, you're really planning long term. That's what my mindset is. But yeah, these elections come around really fast. And I don't know, are you just going to go for the easy route? You're not going to want to upset too many voters. The negative gearing, capital gains tax, I think that's really hard to argue in a rental crisis, because changing those are anti-investor, which is anti-investment, which is what we need for a rental crisis. So I would say that, there's a housing prices are going up, but that's, you'd hard to argue that the investors are causing that, because we do need rentals and investor growth really little, right? You already just mentioned that, how that's not driving the prices. And so I don't know, there's a big tax changes to super. And that is already upsetting a lot of people. And probably the people who are doing the super are also probably they're going to be targeting with the trusts. And so getting these super changes through, I think that's a big thing to get through, let alone trying to make an attack on trusts.
Yeah, I agree with that. I've always tended to be associated with the idea of the long-term view, because I guess once I learned about compound interest and compound growth, and even going back to school, you remember the old Casio calculators and hitting the multiply sign. And so I've always tended to try and think very long-term as an investor. But I suppose the flip side to that, the old John Maynard Keynes quote about in the long run we're all dead. And I suppose the flip side to the sort of 100-year business plan idea in Japan, well, look at a business like, I don't know, Kodak or something, which or Eastman Kodak as it once was, and things change over very long periods of time, and even the very successful businesses can see the business model change, like, I don't know, Blockbuster Video and HMV and all of those companies. So yeah, look, I suppose there's a macro and a micro element to this. I think so. There was, just over the past week or so, that the Treasury released its tax expenditures and insights statement, and the Fin Review picked the eyes out of that and said, look, Treasury's just scrutinising family trusts a bit more. 60 billion of income going through tax-friendly trust vehicles. That's 1.7 million people. So about 11% of taxpayers have trust income in 2021 tax year. And that's up about 200,000 to 1.7 million. So that's one area that I suppose might get a look in. I think it would be pretty typical of the Labour side of politics to take a look at family trusts. And I think as well, people will be trying to bring down that marginal tax rate. If we're paying tax at 47% and we're not getting the tax cuts, more people will look at trusts. I guess there's a question here, Chris, for people who invest in property about whether to invest in your own name, whether to invest in a trust. I mean, this is really a case-by-case basis, but quite a lot of property investors do use trusts, particularly people who need the asset protection.
Yeah, absolutely. I think you just got to be really careful. You just want to make sure that you are getting a benefit there. There are negatives to, how you can offset losses and, capital gains tax and et cetera. So be really careful. You really understand the value versus buying in different structures. We've even seen some of our self-employed clients buying their companies, because it's better to, keep growing the assets in there than to distribute it to themselves personally and pay a big lump sum of income tax. And so absolutely, when the tax rules are changing, change the incentive, change the behavior. Very famous quote, I think Charlie Munger, who's no longer with us, said that. So maybe it was his good friend Warren, but I'm not sure. But I think one of those two Goliaths. But ultimately, I think we've got to expect that there's going to be a lot of attack on inequality. Because it is getting worse, right? Absolutely, there's these haves and have-nots, and it's getting absolutely amplified right now. It's a real, if you've got money that can come down the line, and there is a lot of money. I'm not in this camp, just to be clear. I haven't got millions coming down from inheritance. I'll probably go very little, if anything at all. But there is a lot of money. If you think about the property market, let's say it's worth 10 trillion. It's worth 11 or 12 trillion in a couple of years' time, right? Wouldn't be too much of a stretch. The debt market, the debt isn't going to grow that fast, right? So if the property market goes from 10 to 12 trillion, debt isn't going to go from 2.5 trillion to 4 trillion. It might go from 2.5 to 3 trillion. That would even be a big jump in terms of credit growth. So that means that there's $9 trillion of equity in the Australian property market that is owned at not proportionally. And I even just last week, I know we spoke about this last week, but there's a client whose parents have downsized from a very expensive property in Sydney, and they passed a huge inheritance down to two of their kids, and they downsized up the coast. It's just because the parents go, it's a good time for me to sell. It's a good time for me to buy up the coast. It's not as competitive as it was. And and it's a really good chance to help the kids under higher interest rates to pay off their mortgages or to get them into the market. And so I think that's definitely what a lot of people are thinking at that generation.
Indeed, and in fact, yes, I'm unfortunately, like yourself, not due an inheritance coming my way. But I guess that can keep you hungry and keen to invest. But you've actually very nicely segued, Chris, into our third story, which is where prices have outperformed. And a couple of pieces from Nyla Sweeney and the Fin Review, Ray White research, are basically showing that it's the luxury homes that have outperformed over the past decade. So if you looked at some of the locations, I think people in Brisbane wouldn't be too surprised. New Farm, Paddington, Kenmore, those kind of luxury homes where prices have really gone bananas. It's not just houses either, Chris. I remember all those years ago when the first time a unit sold for $1 million in Sydney and it made all the headlines, Sydney Morning Herald and stuff. And, this week I was just flicking through the news and somebody bought an off-the-plan place at the Gold Coast, $6.5 million, and I think a lot of that is driven by intergenerational wealth. And Australia doesn't have the big inheritance taxes that you see in Europe, and and it's wealth being passed down. Sydney's eastern suburbs and inner west obviously featured as well. And in terms of where units outperformed, it was again premium units in Sydney, Bronte, Tamarama, Bellevue Hill, kind of the places you'd expect. But so homes in the top 5% of the market basically doubled over the past decade. Luxury houses increased by up to 38 percentage points faster than median priced houses. And for units, the differential was 55 percentage points. So yeah, it's I guess goes back to your point, Chris. There's an inequality aspect to this because you have the haves who are getting the intergenerational wealth and inheritances, and the have-nots who have to work your way up in a tough housing market environment. But it does seem to be housing is a big part of that inequality story.
Yeah, I mean, I'd be a bit upset if this article was saying the opposite, to be honest, because, I've kind of been saying this story since I very early started talking about property back in 2012 and was getting educated when I joined a financial advice property, mortgage broking business. I didn't really know too much about property prior to that, to be fair. I quickly sort of try to learn, speaking to lots of buyers agents, looking at what performed for clients. And you could very easily see that, the things that are scarce, the things that are highly desirable to people who are earning a lot of money, plus who have got money, aren't turnovering them, aren't transacting as much. There's less of them available. They're really hard to buy. And people are treating them like forever homes. They're tightly held suburbs. People live in them for 20, 30, 40, 50, 60 years, these properties. And so, when we had clients, we're all the way back, say, 2016, maybe even 15, Pete, we did quite a lot of work with a lot of clients, actually. They bought in those suburbs that we're listing here, the Paddingtons, the Bardens, New Farm, Balmoral, Graceville, looking at how those clients' properties have performed compared to the Brisbane medians in houses, it's chalk and cheese. And even these articles that show outperformance, they don't actually even then show the next level, which is the suburbs the properties within a suburb that outperform that suburb. And they can massively outperform those numbers as well because people pay a massive premium to be on the better streets, the better aspects, the better blocks, the better locations, to schools, to, accessibility of the suburb, etc. And so, yeah, the unit's a really big one. I mean, I had a client this week, which is fair enough. Melbourne couple, got family in Sydney, but, not should we buy a house in Melbourne or should we buy, something in Sydney? And, they had a belief that, I don't want to buy a unit. I want to buy a house. I want to buy land. And, that's a pretty good belief when you think about long-term growth of houses over apartments. And that's definitely the case in Sydney and Brisbane. The housing market gap is quite huge. But when you look at the premium apartments, the bigger, Art Decos, they've been around 40, 60 years. They're bigger, they're sunroof, they've got high ceilings, they're in small blocks of, 6 to 12. They're in surrounded by houses, they're, got parking, they maybe got a view, and they really suit, young couples in the past and maybe more downsizers, but now they really suit the family market. I would say these apartments are a great bet because they're not building any more apartments in these areas at this price point. they're usually a good 50% more than what the current apartments are selling at. So if you think about the premium suburbs there, maybe the apartments are selling circa 1.5 to 2, maybe. But new apartments are selling 3, 4, 5 mil because they're really suiting that cashed up downsizer. And they've got strict planning controls. They will do slight changes, Bondi's changing dramatically, compared to what it was, say, 10 years ago. But they can't keep up with the demand in these areas. They're just not going to change the city, their location that much. So, yeah, it's a lot of people on socials that say, oh, don't buy in Sydney. And they would have been saying don't buy in Sydney all the way over the last, 7 to 10 years. Particularly if you go back 10 years, 2023, 2024, we're good, into a Sydney boom there. And you can see here those higher, cost properties, can't argue with these stats over the last decade.
You can't. I think, I suppose the one caveat that we've probably both got here with the data, well, let's step through it. Premium houses in inner Brisbane, inner West, inner East, inner North, fastest rate of growth nationwide. Yeah, no arguments there. Spring Hill, New Farm, Paddington. Brisbane's inner West, 230% over a decade. Yeah, we've seen that firsthand. Ditto, Leichhardt, Pittwater in Sydney, and the premium market in Sydney, Vaucluse, Rose Bay, Darling Point, Piper, over 200% growth. All agreed. Top tier apartments in Sydney, Double Bay, Bellevue Hill, Bronte and Tama. More than triple top tier apartments. Yeah, that's all true. And I think we can say we've seen examples of that kind of thing. I think you mentioned as well there, Sydney's got the biggest value differential between houses and units. It's a premium of 68%, according to CoreLogic, Tim Lawler. So there's definitely, I think, potential for units in Sydney to do really well over the next decade. I think the one caveat I've got here, Chris, at the data, suburbs where unit values have tripled over 20 years. Erskineville, top of the tree there, 249% over 20 years. I'm going to call BS on this because I actually own a unit in Erskineville. And I think this is where sometimes you've got to drill down a bit. Basically, what you've got is a suburb where there weren't many apartments, then there were loads of new apartments, and that has drilled the median price higher. But you've really got to look at like-for-like sales. That's the true capital growth that is experienced by the investor. Much as I would love to say I've had 250% capital growth, it's been less than that. And that's where sometimes the numbers can get skewed a bit at the suburb level, where you get lots of new properties, same in Alexandria, Redfern and places like that. So I think, as you said, and as you said last week, in fact, the unit market, there's different parts to that. There's the investor stock, big high-rise towers where, very sort of generic capital growth, but it's, generic properties essentially. The stuff that has done well, and you can see that in the stats really, is the areas with 3-story height limits, limitations on supply, blue chip areas in Sydney, in the eastern suburbs, and that's where there's an affordability challenge, but also, as you said, if you've got a property that's got a point of scarcity that maybe is family appropriate, it's got some outdoor space, nice aspect, those are the kind of assets that have done well, not so much the generic stuff that just sells to landlords, I guess. Yeah,
I mean, whenever I see these reports, or this is what certain suburbs have been performing, a good friend, Kent Lardner, he is years of chatting to him very regularly. We always laugh because we can pull to pieces those lists very easily with, like you say, stories of why they're showing which aren't true, and often they like you say, it's the median shifted because before there was very cheap housing there. There wasn't many houses in that suburb, but now there's, farms of houses, and that's pushed up the median because there's lots of houses selling, house and land packages now, or the same with apartments. There wasn't many apartments now. Now there's heaps of apartments that are getting built, and that pushes the median. It doesn't mean the apartments in that suburb have gone up to those levels. It's just the median shifted because of new stock, and there's lots of different, quirks to numbers. And, I don't say that it's the AFR's fault or ILA's fault for doing that because, you do need to go in detail and rule suburbs out. And, it's much easier just to print the list. rather than, dissect it. And that's what I think when been around the traps for a while, you start to see these issues that, aren't really the truth, but they look great on paper. And I think that's the average punter doesn't know that. And so in this situation, they go, wow, Erskine units are the best performing. Maybe even the agents in the suburb will use it. That's even more frustrating when they use the AFR article and to sell more apartments, which wouldn't surprise me. And so, but yeah, you just got to be really careful because that's definitely BS.
Still think if something sounds too good to be true, it probably is. Price performance has been absolutely fine, but it hasn't been 250%. And I think particularly at the suburb level, we used to see this in the old property magazines. If half a dozen properties have sold this year versus last year, but they were more expensive houses or, places with ocean views. Yeah, of course, the median has changed for the types of properties that have actually sold. But there's only really one way to measure, and that's just a like-for-like sale over a given point of time. And yeah, often those sort of really big numbers are not actually reflective of the individual experience. But macro to micro, I guess that's why you've always preached, Chris. And you've got to look at picking out those top-performing assets. So I guess those are the key three stories this week. Big turning point then. Inflation fell more than expected, more than economists expected, but in particular more than the RBA has forecast. So that's a big change for the dynamic, the narrative. And I think the housing perma-bear, sort of bear case has kind of been shot down a bit by that. I do think there's still parts of the country where mortgage rates are really causing some serious pain. I think you mentioned savings rates. I was chatting to Amy this week and we were saying, what are the stats here? Well, the savings rate in Australia has gone from 24% during the COVID period back to 1%, and it's going to go negative. So based on that, there's clearly parts of the country and pockets where people are really under mortgage stress, but light at the end of the tunnel with some rate cuts probably priced in later in the year. Tax reforms, yeah, we pay way too much income tax in Australia, higher than we used to pay from a tax to income ratio. So where that goes next as the political cycle turns, certainly Labor will be looking at tackling that inequality issue, and Family Trust might get a look in. There'll probably be some other reforms on the table as well. And then thirdly, suburbs where premium houses have units have outperformed. Yeah, not too many surprises there. And I guess, yeah, it's an ongoing challenge, isn't it? That top end of the market, not really impacted by things like interest rates and tax cuts, much more by intergenerational wealth or business wealth. And some big outperformance of the top 5% of properties, Chris.
And you made a really good point there, Pete, around actually looking at actual properties and past sales. And I think this is when the light bulb moment was for me. I remember back in 2013, 14, and I just realized there's a big education gap, and I had access to RP data, which I didn't even know what it was. And anyone can get access to RP data, or there's lots of, property data is, much easier to get access and cheaper now than it ever has been. And so you can actually go through and compare, okay, what did that apartment sell for? What does it sell for now? What did a house in that suburb sell for 20, 30 years ago? What did these older apartments sell for? And really just sort of, there's the stats, the numbers are the numbers. And yeah, those sales might have been either a bit of a forced sale at that point, or, potentially great sale price because it was in a boom, and those numbers can get moved a little bit just because of the timing. But ultimately the trend's not. And you can see that things absolutely do underperform and things that have outperformed. And then you can start to look at the reasons why. And so I absolutely recommend that for people, is to, rather than just, look at the big suburb data. Actually, no. Where in this suburb can I look at some past sales? Oh, that property just sold last weekend. Okay, when did it sell before that? When did it sell before that? And you'll start to get a real good gist of what's happening within that suburb and where the locals really want to be. Great chat, Pete. It's another big episode, and so good to be back doing these every week with you.
Too right, yes. If you look at those property figures, yeah, and sometimes you can see, if a price has gone up, yes, because someone's done a massive renovation, and also sometimes you get part sales and the figures look wrong. You try and use a bit of a common sense override when you're doing that stuff. because you do get some outliers, or sometimes fat fingers where an extra zero gets priced on a property sale. So yeah, just use a bit of common sense when you're doing that kind of stuff. So yeah, you know where to find us. Chris is at Blusk for all your mortgage broking needs, and if you're interested in property strategy and buyer's agency, you can get hold of us at Alan Wargent, or you can track me down easily enough online at my daily blog. So that's it, Chris. Enjoy the rest of your weekend and look forward to chatting next week.
Absolutely. Happy Sunday, everyone. Thanks for listening.
Cheers.